Well, the markets are dropping and it is officially cliche season. And there's certain things that you're going to hear over and over. Things like, if you haven't sold, you haven't lost anything. Is that really true? Or things like, be fearful when others are greedy and greedy when others are fearful. You got to wonder, is it really that simple? And these are things that get repeated because they kind of feel smart. They sound smart. They're kind of short. They're memorable. They sound like something that a wise investor might say. But there is a problem here. Most of these things you're going to hear are only partially true. And if you just take them at face value without asking when they apply, what they apply to, why they apply, then that can lead you to make decisions that actually hurt your longer term returns. Now, in this video, I'm going to break down 6 of the most common investing cliches. I'm going to look at the logic behind them, the hidden risks that you might not be aware of, and explain also whether they apply to ETFs or individual stocks, or in some cases, they apply to both. So let's get into it. Number 1, if you haven't sold, you haven't lost anything. Now, technically, this is true. If you haven't sold anything, you haven't realized a loss. But let's be honest about this. The value of your portfolio has absolutely dropped. The money that you have there is no longer available to put elsewhere, and certainly you have lost buying power. The advice here, this is supposed to help people avoid panic selling. And I do agree with that. Avoiding the emotional decisions can be a smart thing, but also ignoring reality. That's not a smart thing. Let's say you bought a stock for $100. It's now worth $60. So you tell yourself, it's fine, I haven't sold it yet. But what if the company's fundamentals have deteriorated? What if there is a better opportunity to invest that money elsewhere? And this mindset is especially dangerous with individual stocks, right? Declines there can be permanent. And you don't have to think that hard. You can think of Nortel here in Canada, Enron, Lehman Brothers. Who is old enough watching this video right now to remember Bre-X? Investors who didn't sell, they saw their positions in these companies go literally to zero. And that means that even though they didn't actually sell, of course, they still lost their money. In these cases, they lost all of their money. Now, when you talk about ETFs, especially those ETFs that track broad indices, the advice here, I think, is a little more relevant. It is safer. Markets do tend to recover over time. But even then, it's important to reevaluate. Are you holding the right exposure? Is the ETF that you have still doing what you think it is? So the bottom line on this topic here is, don't confuse not realizing a loss with not losing money. It's not the same thing. Now, number 2, buy the dip. You're going to hear this over and over and over. And this sounds aggressive, right? It sounds like something that a pro trader would do. The prices fall, you kind of swoop in. It's bold, it's confident. And you know what? When this works, it actually works very well. But when it doesn't work, it can trap you. This cliche assumes that every dip is temporary, that the asset will bounce back. Reality is, though, that some dips are the start of something deeper, a worse decline. Sometimes the fundamentals have changed. Sometimes sentiment has shifted. And those can be for a very good reason. So buying the dip, it only works if what you're buying still is worth holding. Are revenues growing? Is the company still healthy? If it's an ETF, is it still well constructed and aligned with your long-term trends? Now, like the first cliche, this advice can work well with broad-based ETFs. Historically, those markets have recovered and buying a dip has led to strong returns. But again, with individual stocks, it's a far more dangerous venture here. Not every company is going to rebound. So buying the dip in something, for example, recently like Peloton or Beyond Meat or Moderna, you can see on the screen here, those weren't smart buying the dip decisions. It was more like jumping on a sinking ship. So is the phrase buying the dip a valid one? Well, maybe, but only after you've done your actual homework. Number 3, just hold on. The market always recovers. And this one is popular because it feels safe, right? It promises that no matter how bad things get, time will fix it. And if you're investing in a broad market ETF, well, again, something like the VTI or SPY, XUU or ZSP here in Canada, and you've got 20 to 30 years, that might work. History is definitely on your side there. But too many people sort of apply this logic to individual stocks or even niche ETFs. They're ETFs, but they focus on a particular sector, and that is a mistake. And you can ask anyone who held their stocks through the early 2000s, some of them recovered, a lot didn't. If I look at one of the giants today, Cisco Systems, for example, it dropped over 80% after the dot-com crash. It peaked out in March 2000. September 2021, it finally got back to its previous high. So that is over 20 years. Now, yes, it did recover, but 20 years is an awful long time to wait for most people. Also, this advice assumes that you do have the time. If you are close to retirement or you're in retirement and you need that money in 5 years, just waiting it out might not be an option. Which of these phrases have you heard a million times during this market crash? Leave your comments below. Now, I want to talk about advice that is designed to protect you, but can actually hold you back if it is misunderstood. The most obvious to me here is don't try to catch a falling knife. And this phrase is all about avoiding bad timing. It kind of warns you not to just jump into a trade just because it's cheaper today than it was yesterday. It's kind of the opposite of going in and blindly buying the dip. And I do agree that in fast sell-offs, you can get burned. Prices can keep dropping for a lot longer than you think they might. But here is the flip side to that. If you wait for the perfect bottom, that's usually going to mean that you miss some good entry points along the way. And in real life, of course, markets don't sort of go, hey, we're here at the bottom and give you an all clear signal. The best deals often appear when things are at their worst. Now, if you are investing in ETFs, especially the broad market ones, it's often wise to average in during downturns. Even if the drop isn't done, you're not going to time it perfectly, but that's okay. That's rarely what happens. And if it is, it's probably by accident. Now, with individual stocks, though, this knife metaphor, it is definitely more applicable. There are some companies that never come back, as we've seen. So you really do need, in those cases, to look for signs of stabilization. Things like, check the cash flow, management changes. What have they been doing to adjust to the new economy? Something logical that would help you make a good, solid decision. So yes, I don't think you blindly go in after every sort of asset that's falling, but also it's important you don't let the fear paralyze you either. Now, number 5, stocks always go up in the long run. And this one sounds very, very optimistic. It kind of sounds like the market always recovers one. It's very reassuring. And yes, over the last 100 years, let's call it, broad equity markets have definitely trended upward. But this phrase has a massive asterisk that needs to be attached to it. It only applies to diversified exposure, not individual stocks. And not over the short term or even the medium term either. It is definitely a long-term play. The reality is that plenty of companies never come back. We saw that just a minute ago. There are also industries that just sort of fade away. Now, holding a basket of stock, this does reduce the risk, but holding one bad pick, that actually magnifies the risk. And even with ETFs, this is not automatic. You have to ask, what does the ETF actually hold? How concentrated is it? Or really important here, is it too thematic? Is it exposed to sort of long-term growth, or is it just fad related? And a perfect example that comes to my mind here is the Emerge ARK ETFs. And they had a very, very high profile launch. They partnered with ARK Invest to launch the ETFs that were focused on disruptive innovation sectors like genomics, fintech, and AI. And this appealed to a lot of growth-oriented investors in Canada. Now, in 2022, we saw the tech sector sell off, and these funds suffered very heavy losses. They underperformed their benchmarks, and most importantly, investors lost confidence in the funds themselves. In this case, Emerge actually failed to repay over $4.7 million that it owed to the ETFs, and that led to intervention by the Ontario Securities Commission. And by late 2023, all the Emerge ARK ETFs were shut down and liquidated, and that was one of the most dramatic ETF failures in Canada's history. So having an ETF, if it's very, very focused on one theme, also is subject to failing. Now, number 6, be fearful when others are greedy and greedy when others are fearful. Yes, the classic Buffett line. And it is a very good idea, but it's often quoted by people who haven't actually done the homework that Buffett was so famous for. Being greedy when others are fearful doesn't mean that you go out and randomly buy falling stocks. It means that you know what something is truly worth, then you have the courage to buy it when everybody else thinks that you're crazy to go out and do it. This can work well with ETFs, especially if there is broad-based panic out there. If you buy into the market during a recession, when fear is high, historically, that has been a smart move if you have the discipline to hold. Now, with individual stocks, it is trickier. This requires deep research. It requires understanding the fundamentals, the competitive advantages, leadership, long-term trends. Remember, Buffett didn't just go out and buy a bunch of cheap stuff. He was famous for buying quality at a discount. And there is a huge difference there. So I agree, yes, be greedy when others are fearful, but be informed first. Otherwise, you're not being greedy. You're just kind of being reckless. So this simple advice that we've talked about feels good until you realize that it doesn't tell the whole story. Most of these phrases are based on real investing wisdom, but only when it's applied in context. The market doesn't reward blind optimism. It rewards clarity, patience, and research, and knowing when a piece of advice fits your situation and when it doesn't. Now, please leave a comment with the one investing phrase that you've heard time over time, but never really questioned. If you found this breakdown helpful, hit like, subscribe, and as always, thank you for watching. We'll see you in the next video.